Hello listeners and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. In today's pod, we return to the European carbon market and discuss the key market moving developments. After languishing between 55 and 65 euros from around mid-August, the benchmark carbon contract shot up recently to above 70. How high can prices go, or how low can they fall? What are the risks of political intervention? Isn't the commitment of many countries and companies to exit coal actually a bearish driver for carbon? Helping me, Richard Sverrisson, to explain current market dynamics and to look ahead of the coming months is our old friend Ingvild Sorhus of Refinitiv. A warm welcome to you, Ingvild, and welcome back on the pod.
Thanks, Richard, and it's a pleasure to be here.
Excellent. So it must be busy times for you as an analyst in these markets?
Yeah. It's the price has just been kind of rallying for the last few weeks now. So it's quite a lot of stuff to look into nowadays.
Absolutely. So I think if we can start by looking at some of the key events this week. For instance, Germany's coalition agreement. Was this the main reason for prices spiking above 73 euros?
Yes, I would say so. I mean, you saw that on Wednesday that prices were rising at the time of the press conference when the coalition government put out their kind of document that will lay the foundation of their policy for the next 4 years. And I think especially this mentioning of the 60 euro price floor, the new German government wants to see, was kind of a new feature and a bit unexpected that came out. And then market reacted quite on that news, I would say. And of course, that news will just kind of be amplified by technical trading.
Germany has proposed a 60 euro carbon price floor, right? But is that on a European basis or on a national basis? So the way I see it, I may be mistaken, but if it doesn't succeed on a European basis, then they're going to impose it nationally within Germany. Is that right?
Yeah, I think kind of the what we saw from the German government document is that they kind of are in favor of a strong carbon price, and that strong carbon price is one of kind of key element to reach some of the kind of climate and energy goals that they have put forward. They say that they expect the carbon price to rise. But in the case that we'll kind of see a downturn, kind of a structural change in the carbon price formation in the years going forward, that they would like to see kind of a backstop to a potential downward move, put 60 as a price floor. They say they don't expect that to happen, but kind of that will be the case. Of course, the favored option is, of course, to implement this on the EU level. And I mean, we're kind of in the Fit for 55 discussion. There will be kind of the EU ETS directive is kind of reopened. And of course, that could be kind of a new feature to the ETS directive. And we know from before that, for instance, France is a kind of a key advocate for price floors. But of course, getting kind of all the countries in the EU to agree on a price floor might be a tricky one. And then, of course, they said, okay, if we can't do it on the national or on an EU level, then we will implement it on a national level. So kind of to give some clarity for industries and utilities within Germany that, okay, you can't really expect a low carbon price or kind of a drop in carbon price going forward.
The Commission has always been very clear, though, hasn't it? It doesn't like to set caps or floors or to deal with prices. It's more on the supply side measures. But, so is this measure likely to succeed on the EU level?
I think it will be a tricky one. I think there will be quite a lot of countries that will oppose price floor, at least at 60. The idea of ETS is that the market should decide on the price. And that's probably why we haven't seen kind of a proposal by this previously from any of the commissions putting forward kind of proposals. It needs to be a lot of work done, at least, to persuade other countries like Poland, Spain, to accept the price floor into a new directive. But of course, that it's out of the question nothing is out of the question. But then you could probably get some then, okay, then if you want a price floor, then we want a price ceiling. Of course, there will be a lot of kind of elements in a discussion that kind of will be part of a potential kind of price floor discussion.
There are also other elements here that were interesting, Ingvild, particularly coal exit by 2030 and a gas exit by 2040. If we can start with the coal exit, does this mean potentially less demand for EUAs? Is it kind of a bearish factor, whereas the 60 euro backstop is more bullish? But coal exit, what are your feelings here?
Yeah, you would say that speedier exit from coal in Germany would kind of lower power sector emissions in Germany, and then of course power sector in the EU ETS. So in that sense, you will get kind of less emissions from the power sector. But we have the market stability reserve that will kind of be, soaking up some surplus allowances, but also that there is a provision in the EU ETS directive that was kind of that came in the previous review when we had kind of the phase 4 review concluded in 2018. And then you said countries can choose to voluntarily cancel EUAs from their auction volume to kind of dam up for the bearish effect of national coal phase out policies. And Germany has said previously that they are intending to use this provision with voluntary cancellation. So they will see kind of how much is MSR soaking up of this excess surplus coming out of the coal phase out, and then kind of do a voluntary cancellation on top of that to kind of cancel out the coal phase out effect. So I think kind of the like price wise, that's going to be perhaps kind of a limited effect, because we have the MSR in place. We have this voluntary cancellation in place.
It's quite interesting to see a treasury or a finance ministry cancelling voluntarily EUAs. It's like almost like burning money, I suppose.
It's probably kind of would have been a more tricky discussion now to say that we should use a voluntary cancellation now when prices are above 70 than when prices were below 20. It's a bit vague how much kind of cancellation that Germany will do, because that's kind of up to Germany, really. They've said kind of they will assess by use some external expert to assess kind of how much volume should be then cancelled. But I haven't really said that, yes, we are cancelling this amount or corresponding to this amount of historic emissions. We don't know to which kind of a degree the voluntary cancellation will take place.
We'll have to look out for those details in future coalition contracts or agreements there. How about the measures to tackle gas use? Is this also potentially bearish, or do you think you can also see voluntary cancellations here to cancel out the bearish impact?
First and foremost, they've said kind of that they will use this for coal. Of course, they haven't previously been talking about kind of a gas exit as such. But I think we kind of expect to see kind of an increase in gas usage towards kind of 2030 to kind of dam up for some of the, as a transit fuel before kind of you have enough renewables. So I think kind of the voluntary kind of cancellation from gas is not kind of necessarily kind of at least in the 2030 time horizon that we expect too much gas to be kind of phased out. So I think that will be kind of a separate discussion than, for instance, for the forced coal phase out plants.
We see now at the moment, Ingvild, some record carbon prices, but coal generation or coal-fired generation is booming at the moment. Maybe only a temporary blip, but doesn't the fate of coal depend on whether renewables are built?
Yeah, and I think kind of the German government also, or kind of the new German government, are kind of seeing that they would need kind of a quite more ambitious build out of renewable compared to what's planned now. Before we had this German coalition paper out on Wednesday this week, kind of the target for 2030 was 65% of renewable electricity in 2030, and now they say they will kind of go for 80% of electricity should come from renewable sources. And that's kind of up from 40% today. And that's kind of even more than double the demand, because you will also kind of have an increased power demand. So it's quite ambitious, the kind of inclusion of renewable. And of course, you need to make this happen in order to kind of be able to do kind of the speedier coal phase out as well.
Do you have any confidence that these renewables will be built? Often in Germany, you see a lot of the permitting issues, the local planning delays. Do you think these will ease up to allow the expansion of green energy?
I think that's kind of what we see some contours of in the document as well. And of course, you need to speed up on all kind of different levels, like approvals, in order to make this happen. So it's not only kind of a just nice wish, but it will that it can actually happen. And it seems to be kind of, they're saying that they use, for instance, that they want to kind of increase solar power from current 56 gigawatt installed now to 200 gigawatts by 2030. So of course, kind of they're putting out all these plans now, and then it's up to the German government to follow through to make these plans happen.
Very, very ambitious target. So we shall see how much they can build in the next 9-10 years. But moving on from Germany, Ingvild, I was wanting to ask you about your expectations for the rest of the year, basically, and 5 or 6 weeks left. How high can prices go? I mean, 80 euros doesn't seem that unrealistic now. Could we go beyond that to 100? What are your forecasts here?
I would believe more in 80 than 100, I would say. I mean, we have some supportive factors coming up to kind of year end. I mean, we're heading into winter. It's a squeezed energy complex. And I think kind of, for instance, the weather forecast going forward will be important for kind of what's going on in the fuels market. And of course, kind of we expect high coal burn, at least until kind of winter has ended. So that's kind of a fundamental supportive factor why carbon prices shouldn't fall too much, at least. And then we have kind of the auction pause. I mean, you have daily auctions in the European carbon market. And then the last auction this year will be on the 20th of December. So from the 21st of December and until kind of 10th of January, there will be no supply coming out on auctions. And that's kind of a planned pause, and that's happening every year. That's to cater kind of for lower demand during the holiday season. But of course, often kind of in December, we see that, or kind of leading up to December, this is a supportive factor because kind of the prospect of lower supply coming to the market is kind of supporting the market. So that's kind of a supportive element. And we kind of have this year end. Coming into year end, you will have kind of industries and utilities that now kind of are more kind of have a better overview over their actual emissions for 2020, and will kind of do some kind of adjustments to their positions based on their actual emissions going into kind of, or preparing for compliance for 2021 emissions or reporting in April and compliance in or end of April.
So do you expect to be more buying then in the market at this stage and those weeks?
At least kind of this perception that it's not necessarily that it's always kind of the true, but there's kind of a perception in the market that you believe it's happening, especially kind of with this auction pause. I mean, that should be a known thing, and that's kind of half the auction volumes in July as well. Everyone knows it happens, but then every time it's kind of this psychological effect that, okay, we will be without supply for a while. But I think kind of that's kind of supportive factors for the carbon price heading into kind of year end.
Somewhere between 80 and 100 then, Ingvild, if I can pin you down.
I think I would say kind of maybe between 70 and 80.
Okay.
I mean, it has been quite steep, kind of the previous price movement. And I think kind of we could also see some correction as well. So I would say kind of maybe kind of between 70 and 80, but you never know about this market.
No, exactly. That's one thing we've learned here. It's always constantly taking us by surprise. But if we go into next year, Ingvild, so 2022, you see a tightening market. The energy fundamentals, the gas, coal, switch from gas to coal will probably continue as long as Nord Stream 2 flows aren't coming into the market. We could see a bit of colder weather. And on top of that, you have the negotiations at the EU level, the Fit for 55 package. So how do you see the main drivers for Q1, Q2 next year?
Yeah, I think also Q1 will be much of the same. I mean, you have kind of compliance season and then kind of end of or starting of Q2. And of course, we often see kind of this compliance season as a supportive factor. There are kind of there could be industrials or utilities that are not mandated to buy in the forward market, so they need to buy kind of in the primary market just ahead of compliance, which we have seen kind of news reports on in earlier years. That kind of big players, kind of or big utilities or big industrials kind of need to buy in very last minute. So I think kind of that's one kind of important factor for next year. And as you say, kind of, I mean, the winter, I think we'll still see a stress kind of energy complex throughout the winter. So that will, of course, be kind of important. Also kind of the weather forecast. Will we have a cold winter with low wind generation, or will it be a mild winter with high wind power generation? I think that will also kind of course, be have some impacts on the carbon market. But then kind of, I mean, you said kind of we have the policy process as well. We will have kind of a more intensified discussions on the Fit for 55 package. And of course, there has been voices that, I mean, they're stressed about kind of this whole energy situation in the energy market and how carbon is also contributing to that. Of course, kind of this bringing up like speculators' role in this market. Have they kind of contributed to this increase in prices that we have seen previously? I mean, last week we saw the EU securities market regulator ESMA. They came out and said that they had no evidence of anti-competitive trading behavior in a preliminary assessment. I guess kind of the overall kind of agreement is that kind of much of this uptick we have seen is especially kind of this autumn has been much due to kind of the crazy moves in the gas market. But of course, I think kind of, I mean, even though kind of the speculators part has been kind of been said not guilty as of now, I think, for instance, there will be still countries that want to discuss the role of those that have no compliance obligations in also kind of the policy discussions going forward. I mean, it's a shrinking market. And I think there are still some worries from countries that there are participants in the market that could come at the expense of utilities and industry players in Europe. So for instance, that is one element that might not be kind of part of a final framework, but that, for instance, that is one of the topics that could come up and, I mean, could kind of limit the appetite for the upside. And I think kind of it will be interesting to see kind of the bigger groups, like political groups in the European Parliament, kind of what they comes up with, kind of their amendment proposal from the Commission, what member states, how the grouping is for a different proposal, if we will see that there are kind of big resistance for elements of the proposal that was put forward by the Commission. So I think kind of perhaps depends a bit on how the discussions are kind of proceeding, but I think potentially some policy risk could also kind of factor into the market as well.
I'd just like to return to that report by the European Securities and Markets Authority, or ESMA, as is also known. You know, how much stock can we take, or how much can we read into their conclusions? A, because it was preliminary, and B, they didn't have really access to that much data. There was no access. There's no data from the UK, for instance.
I think kind of the increase in prices has not happened in a vacuum for carbon markets. I mean, for one, you have had support from the Fit for 55 package, and also kind of that has been moving, not necessarily now kind of lately, but in the autumn has been kind of moving very in line with, for instance, the gas market. Of course, there is a risk when they're looking more into the details that they could come to a different conclusion. But I mean, at least it seems to be a bit of a relief now that ESMA now came with a preliminary report saying that, okay, we don't see any evidence as of now for speculators to have kind of a big role in this increase in prices.
You know, I think that was maybe a bit of relief to some who are fearing a political intervention on, you know, some member states, Spain or some Eastern European countries already threatened more of a probe into what's going on and maybe a move to intervene. But do you think if prices go much above 70, that these kind of noises will reemerge, that some of these countries will, say they will look at what's happening in the market and maybe, threaten some kind of intervention?
I mean, because it's not so much that the politicians can do. I mean, you can't do too much about the gas market and too much about the coal market. But of course, the carbon market is policy made. So it's really kind of, at least some see this as in kind of the only place where you can actually make an impact that could have an impact on power prices. But of course, I think also that not necessarily kind of too worried about kind of short-term interventions in the market. But I think that these high prices and kind of this energy crunch could also kind of flavor kind of the discussions around the Fit for 55 debate. I mean, there are elements that can be altered, which kind of won't change the overall target, but could have kind of big, large impact on our price expectations and the market balance. So for instance, kind of the design of the market stability reserve. And I think kind of that high carbon prices will kind of set the scene of where kind of the policy discussions will take place or could take place, that you maybe would have kind of some other proposals and some other kind of worries that you didn't have when prices were kind of at low levels where we have seen kind of previous policy discussions taking place. So I think kind of this could color kind of the long-term debate more than kind of short-term interventions in the market.
I think one thing is for sure here, Ingvild. I think we mentioned this on the pod before, but buckle up because there's quite a big roller coaster ride ahead for the coming months and years. So, Ingvild, thank you very much for being a guest on the Montel Pod this week.
Thank you, Richard.
So, listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify or wherever you get your podcasts from. Thank you and goodbye.